Hey, welcome back to the Victor H Investing channel. Today, we've got an interview with a fixed income yield expert, and we're going to be talking to the yield nerd, and his real name is Badri. It's great to have him on this live stream. He has a channel that I really encourage you to visit, watch videos. I've learned a lot from his videos and subscribe to his channel. And his information is on the details of this live stream. But with me is Badri. And Badri, how you doing today?
Very well. Thank you so much for the opportunity. Victor, I find your channel to be just as informative, and it's very clear to me that you have a finance and valuation background because you dive deep and lean into it practically in every episode. So it's wonderful to see it.
Yeah, thank you. I appreciate it. Yeah, excellent. So, the channel, I've learned a ton on YouTube, and I have a master's in business, learned kind of like the mathematics and the arithmetics and kind of like high level economics, but the hands-on, valuing stocks, I've learned so much on YouTube. And that's what this channel is about. It's about just showing examples, because so many examples are out there, good ones. And there's also a lot of other information that I don't listen to, but your channel specifically really goes into, I think, some areas that I'd really like to get into today. But before we jump into that, tell us a little bit about yourself. Tell us about your background, what you're passionate about with regards to investing, what your focus is.
Well, thank you. Well, first of all, appreciate the opportunity to be here. I grew up in poverty in India for the first 19, 20 odd years. And when I say grew up in poverty, I had not seen a microwave, I had not seen a dishwasher, I had been in a car once. And, I got a one-way ticket to Georgia Tech with $600 in my pocket, and the first month's rent was $560. And my parents told me, don't dial back for dollars. And so it's been a wonderful journey. The country has treated me very well. And I studied engineering and then went on to study computer science and then management. And about 17 years ago, I started a software company out of my third bedroom. And sometimes you're at the right place at the right time. And the company took off. We went on to have 27,500 customers, several $1 million in revenue, very, very profitable, absolutely exponential growth. And private equity took notice, and they gave me a number that I could not say no to. I had not raised outside capital. The company never went into debt. And so it was an all-cash transaction, and I'm very thankful to say it enabled me to be financially independent just about 4.5 years ago. And I was never in the stock market outside of my 401k and retirement plans until that time. And so I had this money, I didn't know what to do with it. And my wife, I'm divorced and remarried. She said, I've been using this financial advisor and, he's wonderful. And so I said, sounds good to me. And, for a meager 0.5% a year, he would talk to me for an hour a month. And he would say, how are you doing? Let's move the 0.02% of your portfolio from here to here. And I would say, what about everything else? What are the trends? And after about 2 months, 3 months of that, I kind of got to the point where, well, I have free time. I'm semi-retired. I want to do something more than move 0.02% of my portfolio, every month. And so I very politely told him, this isn't going to work for me. I'm going to drive the bus. But I did not know much at all about the markets. And so I decided to learn on my own. And this goes back to 2020. And about 2021, I started buying my first bonds. And I had bought some stock only because, frankly, and I don't mean it in a bad way, but the learning curve to trade stock, thanks to Robinhood and some of the others, you swipe and click and you own something. Whether it's the right buy or not, nobody knows, but it's easy to buy. The learning curve to buying a bond is itself tougher. You don't know what exactly it is. You don't know what your return is. And I learned it the hard way. I made some bad decisions as well. And then you start diving deeper into not just what you want to buy, but why. Is it the right time? When do you buy? And so that journey started, and a year in, I could see that I was able to talk in a much more educated manner. And so I decided the greatest help I can do is to share my learnings. And I have a son who is 17, and I try to teach him. And it forced me to explain things in a very simple manner. Now, 5 years ago, my son was 12. And so I decided I would explain bond investing to a 12-year-old. And so I started the channel Yield Nerd. And we talk about tomato farming and lobster farming. We just use very simple analogies to explain what bond investing is. And it builds from there. I'm on episode 122. So we're coming up on almost 2 years. And that's been my learnings. By no means am I an expert, but I certainly am far ahead of where I was 4.5 years ago.
That's great. That's great. Just a really inspiring story. Congratulations on, starting a company and then selling your company. Congratulations on that. And, your journey with having a financial advisor. I too had a moment like that where, I had done really well with real estate and wanted to potentially, improve my performance. So I hired a professional who charged me, and I'm okay paying people what they deserve to earn. I'm okay with that, and I'm a professional, so I get paid well as well. So, but the outcome from a education, perspective, that advisor didn't educate me at all. And in fact, I was bringing more ideas to that conversation than he was. I would ask, why are we going with this type of allocation? And he was uncomfortable with me asking, and he was uncomfortable with the depth that I wanted to go and understand. And with all, due respect, I would share with him that, I've worked hard for my money, and, where I park it and how I invest it, I have to know. And that's just who I am. And it ended up being a year-long relationship. We ended on amicable terms, and I went my way and committed to just doing it on my own, because I was really probably wired to do it on my own. And at that point, I did have a lot of experience investing. So interesting that we had a moment like that. Okay, so you've got a terrific background, very systems and engineering focused. As we look at the market, just to start high level, what type of investor do you think really benefits from fixed income bonds and that type of investment?
Well, the usual answer to that would be an older person who's risk averse. But I would very humbly say that you should be the investor the economy is headed towards in the next few months. And I am not a purist. I used to have 70% in equities. I am now 99.5% in fixed income. And there is a reason why I went from one extreme to another. I anticipate some rough waters ahead. And so it has nothing to do with, should you be one kind of an investor or another kind of investor. And I would readily submit that the first 5 months of 2024, the equity investors have absolutely crushed it on returns, and I'm very happy for them. We are heading up to a contentious election. It doesn't matter which side of the aisle you are in and where you are headed, but we're headed towards a contentious election. And my faith in the American public disagreeing agreeably is not as high. And so you have to then ask the question, if there is volatility, how are you going to react? What will happen to the market? And very much like Victor, you say, and my instinct, there are people who claim to know what they know, and then there is instinct, and all you can do is your own research, read and listen to shows and whatever else, however you gather your information, and then you are going to make your own judgment call. And my judgment call is a lot of turbulence for the equity market at the end of the year. So the very long way of answering your question, what kind of person goes to fixed income? When you anticipate storm clouds in the horizon, I would very humbly say that most people should think about a greater allocation in fixed income.
Yeah, and just so looking at, and I'm showing the S&P 500. If we look at October 14th to this point, we are up 48%. Now, I celebrate it, and at the same time, the party is not going to go on forever. You could see that we had a pretty good pullback in 2023, very recently in the last 12 months. And then if you look at the top that we reached, I believe at the end of 2021, and look at the trough, we had a pretty good correction. Now, is it going to happen at the end of the year? Maybe. Can't say that it will. Can't say that it won't. Are we going to have a major correction like this one in the next 3 years? I would be 80 to 90% sure that. Is it going to happen in the next 5 years? I'm 99% sure that's going to happen. So I agree that when this happens, and this period of time is kind of different for fixed income because interest rates were so low and interest rates are rising so high. But I agree with you that if you diversify into a non-stock, non-equity investment, that might shield your portfolio from that volatility. So let's talk about two kind of types of investors: the young investor that can diversify, and then the older investor that really is looking for assured income and so forth. For that young investor, I guess, what would your advice be as you look at fixed income? You're talking to one of your sons or a friend of your sons, and they're saying, "Hey, Badri, give me some advice here. I'm making a decent income now that I'm out of college. I'm making however much, and I'm putting away $10,000 a year. How should I be investing in fixed income?"
So I'm going to use an analogy I've used in Yield Nerd in the very, very beginning. I would ask the kid whether they have enough money to buy lobsters or enough money to buy tomatoes. And where I'm going with that is, tomatoes are $2 a pound, and you can buy them. It's very affordable, so you tend to buy more tomatoes. And if they go waste, that's okay. You can always buy more. However, lobsters, these are $30, $40 a pound. They're very expensive. And then you say, well, let me look behind the scenes into the tomato farmer and the lobster farmer. The lobster starts out at this teensy-weensy, really small thing. You can't even see it. And you have to keep feeding it, and it grows and grows and grows. And you have to hope that the big bird doesn't come and eat the lobster, because if it eats the lobster, you go to nothing. Well, the tomato farmer has a very different dynamic. You put the tomato plant, and as long as there is sunlight and we water it here and there, maybe it rains, not only do you get to pick one tomato, you wait for another week, you pick another tomato and another tomato and another one. So the rewards aren't this giant $30 lobster, but it's this $2 tomatoes every week for many, many weeks in the summer. And the psychology really between yield investing and equity investing is exactly that. An equity investor is growing that tiny lobster into this big, big giant, and you have to balance greed with reality and say, is the lobster big enough? Should I take it to market now? Or am I going to keep feeding it and hope it grows and grows and grows? And the tomato investor says, this looks ripe, it's red in color. I'm going to pick these 3 this week, those 3 another week. So to the youngster, I would say it probably is a little bit of a combination of both. You do want to make sure, can you pay your electricity bill without any doubt of whether you can afford it or not? So have some kind of an investment that takes your electricity bill out of the risk picture. And then eventually, can you pay your rent? And eventually, can you pay your rent, your electricity, and go out for nice dinners with your significant other and invest the rest in risky assets? Now, as you go towards the older and older investor, then you want to say, look, you don't want the chance that next week you may not be able to afford this fine vacation with your wonderful partner. You want to make sure more of it is in fixed investment. So it becomes a curve. 99.5% is egregiously high. I am in that scenario only because I expect storm clouds. Maybe it's some other number, and I'm no wealth management advisor to tell you 60, 40, 70, 30. All those are humbug. It's really what you think is the right number based on your information and also a macroeconomic prediction. And that's where you should allocate your resources.
Very good. Good. So we've got a couple of questions coming in. Maybe we can take a question if we may. So first one was, would love to learn more about bonds. Any thoughts on T-bill funds? Do you like investing in ETFs and funds versus individual bonds?
So again, I have my biases, and I stay away from any bond funds for 5 reasons. And at some point, I'll share with Victor specific episodes where we take 10 minutes to dive deeper into why. And I don't want to pick specific funds. I have no allegiances for or against any of them. The challenge with a bond fund is that you really don't have the concept of getting your par value back. Let me explain what I mean by that. Let's say that you bought a T-bill for 96 cents and it slowly marches towards 100 and you get your 100 back. How wonderful. Well, if you bought a bond fund at whatever this is, $41.23, and at some point you say, well, I don't want to be in that bond fund anymore. Well, you're stuck. It's at whatever price it is on that day. And you're sitting here saying prayers that that price is at least $41.23. You have no control over it. And so the idea of a fixed income, and that's why it's an oxymoron. If you are a fixed income investor, you know what your fixed income is, and you hopefully are going to get your money back. If those two conditions are not met, a bond fund cannot guarantee you that your par value will come back. There is no such thing. Well, guess who eats that? Is the bond fund manager. And I don't mean anything bad against bond fund managers. They're providing a service and they are getting compensated for it. But they take your money and they go buy bonds and they eat the administrative fee. When the bond matures and they become the 100 cents, you don't see it, they see it. And there is a question about bond ETFs. Whether it is a bond ETF or a bond mutual fund, at the end of the day, the price of the ETF is based on what's fancily called net asset value, which is how many people are still parking their money on it and how does it perform. And so if you believe interest rates are going to go up, I would want to get my money back, the whole 100 cents back, so I can put it to work again. If you believe interest rates are going down, then why would you want to be in bonds in the first place? So buying an ETF in today's market is risky. But when I say ETF, buying a bond ETF or a bond fund, at the end of the day, it all depends on what your skill set is and how much time you have. Some of us cut our own lawns. Others say, I don't want to cut my own lawn. I'm going to pay $50 or $60 or whatever you pay and have someone else cut the lawn. And arguably, they may do a really good job and it's not worth your time. Well, if it is cutting your lawn for $60, that's one thing. If it is your sustenance and if it is how you're deriving your income, are you going to outsource that to a bond fund manager? And the reasons for and against, now, if you have a full-time job, you don't have a lot of time, and you just say, well, I look at historic returns, and that is where I have a problem. Interest rates have gone up meteorically. There is a quote, bond bull market going on. Everybody in the bond market looks like a genius. They can say, look at all these returns we've been giving. Well, then you ask them, well, what happened the 5 years before? Well, that doesn't matter. We are here. In the same way, an equity investor could also say, look at my run. We've had a 10-year bull market. And I would say, how did you do during COVID? Well, that was an anomaly. And so if you want more stability and you have a reasonable amount of time, what I mean by reasonable is I would say about 30 minutes a week, maybe 30 minutes every other week. And let me explain what I mean by that. As of now, the smartest place to be is short-term bonds, not long-term. And I'll tell you my thesis on that, and you should do your own due diligence. Let's say that you had, I'm making up a number, $10,000 to invest. And you took 2,000 of that and you bought 9-month bonds. You took another 2,000 and you bought 6-month bonds. And you took another 2,000 and you bought 3-month bonds. and you finally have the last few thousand. And I would buy 2 and 3 week maturities, and I'll tell you why in a second. And when you do something like that, for the next 3 months, you have nothing to do because your 3 months bonds mature after 3 months. And when they mature after 3 months, your 6 months bonds still have 3 more months to go. Your 9 month bond has 6 months to go. So you would then buy another 9 month bond at the end of 3 months. That concept is called laddering. And so you literally only have an hour of work every 3 months in that scenario to make 5.5%. What do you do between the 0 and 3 months? You could do one of two ways. You have your allocation on equities. Maybe you get tempted to say, I'm going to move more of my allocation to equity. There is nothing wrong with equities. I certainly don't mean to say people who are in equities are doing something very risky. Your returns are amazing. So maybe you want to take some of the returns and put that back into equity. Or there are what I would call last minute deals in the bond market. Now, what do I mean by that? Some unfortunate person may have a really urgent need of cash that they are willing to dump their treasuries literally 2 weeks before they mature or 3 weeks before they mature. And I wait for those opportunities. And when they are dumping those treasuries, because maybe there is a short they are covering, maybe there is a margin call, and the only place they can go to is to sell their treasuries, they are willing to offload these 2, 3, 4, or 1 month treasuries in huge discounts. I just bought one last week for 6.8% yield to maturity. And that's a fancy word, and we can talk about what that means. But take some of your stocks and tell me, how often have you made 7% a year? It doesn't mean 7% in one day, 7% in a year. Now, if you held something that had a yield to maturity of 12%, if you held it for 1 month, you would only make 1%. In other words, that is the total you would make if the party were to last 1 year. So when the government says we'll give you a yield of 5.5%, it's like buying a CD for $100, keeping it for a year, and there is $105.50 in there. That's what the government is saying. And so if instead you were to buy something that was $100, the yield to maturity, I'm using simple terms, was 12%, but you only held it for a month, you wouldn't have $112, you would have $101 because you held it for 1/12 of a year. Now, my simple question to you is this. If you know you're going to get your $100 back, and there is no doubt about whether you would get your $100 back, and somebody says, hey, I'll hold your $100 for you, and I'll give you back 101 in a month, and you are sitting here saying, I'm going on a vacation, I'm taking my summer off, you're doing whatever you're doing for a month, that you are okay parking that money for a short period, and somebody can give you 6%, 7%, and oh, by the way, it's state tax free. I don't know where many of you live.
Let me ask a couple of questions. So I get that, the very short term, and I would call it short term ladder. Now, back to an ETF, I buy principally bonds and individual bonds, and I think I own one ETF. But you could go into an ETF, especially like a Vanguard like product where it's very low management fees, and you can get in and out. Those are very easy to get in and out of, like a stock. And bonds are a little harder to get out, like you just mentioned. If you needed that money, it'd be harder to sell. Is that correct?
Depends on the bond. If you bought a Boeing bond for 9 years, then there, and I don't mean anything bad about Boeing, you could buy any corporate bond at any credit rating, but a very long duration. If it's a corporate bond, there is X amount of demand for that. Every single day, $2 trillion of debt exchanges hands in the treasury market. You will have zero problems exiting treasuries on any given day. Now, if you are the idiot who's selling after market because you need to cover a margin call at 11:30 at night, it all depends on your asset allocation.
Yeah. And I think, judging from personal experience, if you take an individual bond, let's say that Boeing bond, it's not as easy as like you go to a stock and you say, I want to sell 10 shares and immediately it's done. You have to basically offer it up and then somebody will bid and then you
No,
accept
no,
it. Might take some time, isn't it? Isn't that the
no,
case?
no, 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 no. So depending on which broker you use, and I don't want to plug any broker. I have no financial allegiances, but you know the big ones, Schwab, Vanguard, whoever they are. There are So to put it differently, the bond market is 3 times larger than the stock market. You can Google that and look at it later. So for every time you want to go sell a single stock, any stock, and you look at the volume it trades, practically the bond market is 3 times that everywhere. And so the idea that you're going to be there for a very long time and nobody will be able to buy it, that's not at all. You could sell any bond at any time. There are people who say, I have a price and I only want to sell this price. Individual bond investors cannot do that. However, you can go there and see what people are willing to pay for it. And you can say, I will accept it exactly at that price or not at all. It's called
Right.
fill or kill. And
Correct.
so the opposite, where you just want to dump it, is where you do a market order in stocks. You don't have to do a market order. You can go in that example bond, the long-term 10-year bond of company XYZ. You can go see how many are there as of this second to buy this bond. What are they willing to pay? And you can say, I accept that specific deal, or I'm willing to wait. The better way of thinking about it is put your allocation on fixed income of the amount that you really will have no problem holding to maturity.
Correct.
That would be the best mindset. If you are a day trader and you're fidgety and you need to keep doing this stuff, then stay on equities,
Yeah.
or do what I said, where you take a really small percentage and you screw around with that because you have nothing else to do, and you're like, oh, I made 6% for 2 weeks or whatever it may be. But the bulk of your fixed income should be just that. It's fixed income. Let it passively
Perfect.
produce returns.
So let me catch up on some questions and comments, and I wanted to help let you kind of take on the questions being asked. But before I jump to this question, just want to shout out everybody who's joined. Thank you so much. Shadow Guy, Tatcha, Android PC, Empty Design Mill, Neil Weston. Thanks so much for joining. Really appreciate you. We're going to be getting deeper and deeper. Please keep asking your questions. We're going to get to them. It just may take a few minutes. But first question up for you, or the next question, I should say, is I'm tempted to DCAing, discounted cash analysis, or discounted uh, I guess, discounting the cash flows of a bond, long-term bond, and hoping to keep the bonds till maturity rather to sell bonds when interest rates come down, 3-year horizon, and getting capital gains. So I guess, how do you look at, now we're talking about a 3-year horizon or maybe even longer. What are your tips on how would you discount that? What's your decision process look like around a longer term bond?
It all depends on what you believe is going to happen to the economy in the next 3 years. And I would be the last person to tell you I have an expert view and here is what you should do. But you sit here and tell me, and I'll give you my inclination, but you have to use yours. You have to tell me, given where debt is in the market, and given where valuations are in the market, if you are going to buy a corporate bond, you really think the average company with an average credit rating, is going to be in a better credit rating 3 years later or a worse credit rating 3 years later? If you were to tell me that you were going to buy that bond and hold it to maturity, as long as the company doesn't go bankrupt, you're going to get your $100 back or your par value back. But you want to play this a little bit and hope that you are the guy that caught it, or the woman who got it, when the bond is going to increase in price because interest rates are decreasing. Maybe you are the one person who got the right one. It's a very risky play at this moment for 2 reasons. And again, please don't take my statement politically, but you have to sit back and think about the American debt to GDP ratio is north of 100. It's predicted to go even higher. If we keep having more and more debt, somebody has to buy that debt. And it comes down to a simple question. If I come to the market every week with 5 pounds of tomatoes, and there are these three customers who come and they each buy 2 pounds, I get to tell the very last customer I sold out of everything except 1 pound, and I get to increase the price. I know you're desperate for tomatoes, and so I'm going to get a greater return. Well, what if I keep coming up with 10 pounds of tomatoes and 12 pounds of tomatoes? Now, all of a sudden, the customer only still wants to buy 2 pounds. I have to tell him, would you please take 3 pounds or 4 pounds? I will give you a deal. Take more tomatoes. The government is the one selling the tomatoes. The government is selling the debt. You and I and the bond manager in these funds and shares, they are the buyers. They are there with the fixed demand. All of a sudden, if the government wants to send more debt to the market, which is not a question of whether it'll happen, it has to happen. Because if we raise debt at 5.5% and it matures, well, you have two choices. The government can suddenly print more money to pay that debt. And if we printed more money, then the US dollar is going to crash. Or we can borrow even more to pay off the previous debt, which is like taking a new credit card at a higher interest rate to pay the old credit card. And that is exactly what's going to happen. The scenario that the interest rates are guaranteed going to go down in the next 3 years is by no means a given. There may
I agree
be,
with that.
yeah,
So,
there may be a scenario where it goes up.
but let me in the DCA he meant dollar cost averaging.
Yeah, I got that.
So, and I get your point of view, and there's an infinite number of ways that an investor can invest. And my approach is really to simplify, because when you deal with the macroeconomic environment and then you deal with the micro and you deal with all these, in most cases, subtle ups and downs, it just gets overly confusing. So I like to simplify as I look at fixed income and bonds, which is, conceptually, do I believe in the United States? Absolutely. And it's gonna, the United States is gonna be around for a while. And do I think that there's a lot of debt that you have? Yes, but it's always been that way my whole life. Having said that, what are the things that I can control as an investor? I can control looking at the company that's issuing the bond. Of course, if the US government is issuing it, I'm good with the US government. I think they're going to be around. What's the other thing I can control? What's my yield? Okay. I control analyzing whoever's issuing the bond, the yield, and the term. When do I want this money to come back home? In 6 months, in a year, in 2 years, in 5 years? In my situation, I have a lot of other things to do, so I don't want to touch my bond portfolio excessively. I have a bond ladder that goes out 5 years and actually have longer term bonds. The cash in the current year, if I have it in a money market account, and it does about close to 5%. So if I'm going to touch that money and get an incremental 0.5% yield, it's not worth it. In my equity fund, I'm doing, like you were saying, my growth fund in 23 did 38%. My income fund did 16%. My bond fund did less than that. And so that's, it's kind of, there's no one way to invest, is what I want everybody to hear is, I encourage that you simplify, get into a process that you understand and you kind of feel empowered. But if you get the right information, 7 out of 10 times, you're going to make a very good decision. 1 out of 10 times, you're going to make a mistake and you're going to be like learning from that mistake. And that mistake may cost you a couple bucks. 2 out of 10 times are going to be marginal. Well, I did a little bit of a mistake. I did a little bit of a gain. But overall, that's one thing I would put out there. So,
the caveat I would add to everything you are saying is, and Scott says he has made so many mistakes, we all have, As long as you know you're going to get your money back, whether you made 5.5% or 3 point, at least you can say, okay, I got my money back. And that is where lending to the government has that benefit. Buying individual bonds has that benefit. You know you are going to get your money back. And that is where I have a problem with the ETFs. And somebody posted that BKAG has 0% management fee. To be very clear, I don't have anything against BKAG or any other fund. There are many of them who give quote promotions. This month alone, it's no management fee. Let me ask you this. Are you willing to manage the funds of a bunch of people, pay for an accountant and do all of that for nothing? It's a free lunch. Does that sound good to you? I just don't buy these no management fee this month only. Well, what happens next month? What
Like
happens if I sell something?
Vanguard uses computers, right? It's algorithms are buying and selling. So you got to buy the computers electricity, and they got to pay for the computers. I think I'm a I don't know how to say it, but I'm a believer or fan or appreciate companies like Vanguard, because they did take mutual funds, which used to cost a percent, percent and a half for them to manage your money, and they said, oh, we're going to charge you 0.03%, which is way lower. They're still managing the fund or the ETF. They're still charging something, but it's a tiny fee, and they're doing it based off of algorithms. And I'm a believer that you pay the least expensive management fee, period, on any fund or ETF. High management fees are not good.
I like zero. I like zero as the fees.
I agree, but you're not paying zero. Just to point out, you're spending your time, you're spending your electricity, you're spending your computer, you're spending, let's just call it your time. You're not paying yourself, but you're spending that time. All right, let's move forward a little bit. Here's an interesting question. Would be interested to learn where and how to buy these distressed bonds. Tips there on where you're finding distressed bonds.
Yep. To be very clear, I do not personally advocate. I do not own any distressed bonds. The word distressed bonds means different things to different people. So the high yield bonds, and if you want me to rattle off ETFs, I will, and I have no relationship.
Junk bonds. You don't buy junk bonds.
Yeah. So there are ETFs like HYEM. Those are purely bonds of companies whose credit rating is a BBB minus or lower. And as interest rates have gone high and they stay high, these companies will have to borrow at prime plus 8%. So they are paying 13, 14% to keep the company afloat. They are dead. And BDCs or business development companies, where somebody has a claw on them, there is an ETF called BIZD, BIZD. And BIZD owns a large number of business development companies, Owl Rock Capital. I mean, all of those are available. I would very humbly submit to you again that if there is a company that is already having a cash flow problem, those are the only ones that would go to a business development company. If they already are having a cash flow problem and they are paying prime plus 8% and 9%, as interest rates stay higher for longer, how stable do you think those companies are going to be to service the debt? And that's the debt service that BIZD takes and gives it to you as dividends. So I want to get back to where do I buy these distressed bonds, because I did make a statement that I buy last minute bonds, and I'm going to come there for that. So when I say I buy these bonds at a deep discount, they are not BBB minus. These are US treasuries. Let me explain where I buy them. That I understood. Correct. MT Design Mill. I understood. I just wanted to clarify in case someone else read it differently. I would go exactly to the treasury brokerage. I use Schwab. I'm not plugging them whatsoever. But when you go to search on Schwab, they show you a fixed income table. They say 3 months, 6 months, 9 months, and there is a number there. What is not known is if you click on the 3-month number and you modify the filter, you can then say, tell me in the 0 to 3 month period, what do you have? and there is nothing on the table to show you 0 to 3 months. And when Schwab comes back with here are the bonds for 0 to 3 months, it is sorted by the date and not yield to maturity. It is very weird, but that is how it is sorted. And I then sort descending by yield to maturity, and that yield is often higher than any of the yields in any of the data in the table. And within that, you then go look at what's called market depth. I can share if you would like, Victor, and I can pull up. I don't know what you want me to do. I can show it live.
If you want to cue that up, and then on your interface, are you able to share your screen?
Yeah, give me a second. I'm gonna log in, and
while you do that, I'm gonna answer some questions and say hello to some people. First, Scott's Due Diligence. Thanks so much, Scott, for $20 generous super sticker. Really appreciate that. I feel humbled because I think I owe you a lot of money for all the analysis that I've seen on your channel and benefited from watching your channel. So thank you so much. And then again, thanks so much for all the questions. We're getting into ETFs, and I think Badri is really getting into the details of individual bonds. So we'll continue on that path. And if there's any other questions out there, please hang in there and we will get to everything.
All right. I'm ready when you are, Victor.
Okay. So you could just share your screen when you'd like.
Yep. All right. So here's what I'm going to do. Let me first answer a question that was asked earlier. This is a slide that I used in my most recent episode. There was a question about...
One second. Okay, go ahead.
Yep. There was a question about, can I buy a corporate bond and hang on to it for 3 years? And here is the yield curve. I monitor the yield curve, every so often and compare it now versus the past. And you can see that in September 2022, we had a somewhat inverted yield curve, but not too bad, meaning you got paid more if you held a longer duration. That's what is called a non-inverted yield curve.
And then, traditionally, just to kind of get our minds around this, traditionally, the rule of thumb is if you buy a longer term, let's say a 10-year bond, you'll receive a higher yield rate because you're taking more risk. Hey, I'm going to lend you the money for 10 years versus lending it for 6 months. Is that correct?
So to say it again, and using tomatoes and lobsters and things like that, if I were to say, Victor, do you have $100? I will return it tomorrow for sure. Can I give you $100.25? You're going to say, well, you're only gone for 1 day. I know where you are. Okay, that sounds good. But if I said, Victor, can I borrow $100? I'll give it back to you 10 years later. You're going to be like, how do I know? And you're going to say, well, you better pay me in between $5 every 6 months. And you're going to come up with all these additional conditions. Inherently, because I'm walking away with your money for longer, you want me to make it worth your while. And that is this curve. And the x-axis is time. And as you are willing to give me that money for longer, you are asking for more in return. And here is the complete weirdity that happened. So we went from this to October 2023, and nobody talked about a soft landing and all of that. Look at this craziness. You want more premium, you want more returns for 3 months than 10 years. How could that possibly be? But that is what was the reality October 2023. And then came this talk of soft landing. We don't need bonds. Equities are the jam. And it became extremely inverted, which means holding longer term bonds was a fool's errand. And then here is where we are right now, May 2024. Short term is still king, but you can see that if you call this a tail, the tail is lifting up. And so my comment to the person who talked earlier about, can I hold a longer duration? Imagine you bought it in this gray area, and the gray area is not too long ago, it is 3 months ago. 3 months ago, a 10-year paid 3.9%. Today, it pays 5.5%. To be clear, it's 5.5% including the state tax break. And I say all of these because I do this thing called the yield Super Bowl.
I have a question on the
Mhm.
yield curve. And so here's my question, which is, now I would not argue with the expectation that interest rates will go down. Now, I'm not here to tell you that I know where interest rates are going to be in a year or in 2 years or in 3 years. But I would say, given the fact that they've gone up so much, and I would probably say, if I had to pick one or the other, I do think they're going to
Of
go down.
course, of
Now,
course.
put that on the table. Now, for the investor that's like, hey, I'd like to lock in a higher interest rate while interest rates are elevated, why wouldn't an investor say, yes, I've got my short-term bonds, but I'd also like to lock it in for 5 or 10 years, because then I can lock it in at 5, 6, 7%, especially on corporate bonds.
Yep. So the answer I would have for that is, does the 4.5%, 5% pay for your electricity, your rent, and weekly sushi?
But let me
In other
clarify
words,
something there. Let me clarify something. That you're right that the specified interest rate, let's say on a treasury, says that it's going to be a 4% return on this 5-year bond. But what you're going to get is that bond is going to be discounted to compensate you between the difference of 4% and, let's say, the yield that it has to sell at, which, let's say, 5%. So you're getting a less than par price on that bond. And the difference is going to be made in defined depreciation between the time you buy it and it matures. So you really are, in my mind, again, I keep it simple. In my mind, you're making 5%. You're not making 4%. You're making 5%. Now, they're not going to pay you the interest payments. So I think your statement is true, that you're not going to be eating off the appreciation on the bond itself. But overall, the return that I'm seeing is higher than the interest rate on the bond.
to say it differently, you could buy a brand new 10-year bond in a treasury auction and indeed make 4.8%, 4.9%. No problem with that. My question again would be, if you can live off the returns of that 4.8% and you can, worst case, hold that to maturity, then by all means increase duration when you know that the returns are good enough for you. What I wouldn't do is the risk taking of, well, I'm going to buy it now because I think it's going to go down and then I'll sell it. And then that's more speculation, in my humble opinion. I would go into fixed income if I have no problems holding it to maturity. The number of
Right.
times I sell a bond or a treasury before maturity is near zero. That's
Yeah.
the only condition. I toss and turn treasuries because I own a whole bunch in very short durations. Every week, 2 or 3 mature for me. I play with those. The
Yeah.
ones I buy, I keep.
Yeah. And just to add on, because I think most of your investments are fixed income. So this is your wheelhouse. Whereas opposed to my investing, my biggest, item on net worth is real estate. Second biggest is stocks, and then bonds, and then a little bit of cryptocurrencies. So for me, my point of view is, if I can set it and forget it, so to speak, and say, okay, I want some of my net worth to be put into bonds, and I want to basically have a defined return for a portion of my net worth. And it's not a major portion. It's like 15% are in bonds, because I spend more of my time on stocks. That's what takes my time and energy. So I think that's important to kind of note is, because I think the audience, you may be, if you're principally a fixed income investor, Badri's strategies it's a perfect match there. If you're more like me, then I really learned from Badri, but my point of view and my kind of outcomes are a little different. I'm not depending on the money. It's money that I don't need. I just put it away, and I want to diversify, and I want to get good at it, because someday I'm going to wake up and say, I just want to live off my income, which would come in bonds and dividend paying stocks. And when that day comes, I want to be ready for it. I want to have some practice. But I wanted to put that out there. Please continue.
Yep. Going back to the question from earlier, which is where do you find these within quotes distressed bonds? And the market is not open now, so I have no idea how this search is going to go. This is Schwab. In Schwab, I'd go to fixed income and it would show the screen. This is the duration. The yield Super Bowl, as I call it, goes off of this. If I were to only trust this screen, I would say the highest yield I could possibly make right now, I would argue, is 5.3% for 6 months. Watch what happens. I'm going to click 5.25 and it says 5.43. And you go, wait a second, I thought I was supposed to look at 5.25. That will say, hold your horses. And I'm going to say, I want to modify my search.
And
I'm willing.
I'm sorry, Badri, if you're showing something, we can't see it. We're still seeing Treasury Deep Dive.
Oh, sorry.
There we go. Now I can see it.
Okay. So in Schwab, you would go research, bonds, CDs, and fixed income. And here is the fixed income table. And this fixed income table, you're seeing that, right?
Yes.
All right. This fixed income table shows that the 3-month return is 5.25, the 6-month return is 5.3, and then whoop, it goes down all along the way, the quote inverted yield curve. So if I had $1,000, I may naively think, looking at this particular window, that the highest I can make is 5.3 for 6 months. And I may dive in there, except somebody asked, where do you find these within quote distressed bonds? Here is what I do. I click on 3 months.
Yep.
And already I can see, whoever built the software is a genius. The summary shows some random number 5.25. I'm already at 5.43. And then I'm going to say, let me see if I can beat that. So I'm going to go to modify search. And I'm going to say, I'm willing to buy bonds that mature tomorrow. And I'm willing to go all the way until the election in November, which is kind of my D-Day, if you will, because I expect a market crash around the election and I will switch hugely to equities. So I'm just waiting. And in my opinion, I'm waiting risk-free because I'm making 5.5% plus state tax-free because Treasury returns are state tax-free. So it's really 6% return. And I'm going to say, show me any and every bond you've got. And Schwab does not sort by yield. Don't ask me why. These are all quirks in their software. I'm going to go here and say, sort descending on yield to maturity. Look at that. Now I'm at 5.47. We already went from 5.25 to 5.3 to 5.7. Watch what else happens. I'm then going to go here, and this is called market depth. This is the real active market. When there were questions asked earlier about, hey, can I sell it at a fixed price? If you go to market depth, this may not show anything at all because it is showing. Oh, see where it says view only? The reason it says view only is because the market is not open.
Right.
Check this out. I can make 5.59%. So you may remember just 2 screens ago, I was at 5.25. Now I am at 5.6, and that's state tax free. And Illinois has an 8% state tax. This is like 6.08. And what you will see sometimes is this will already show 6.1. And this party, whoever this is trying to unload their bonds and say, you keep this, you buy this, lend the government for 1 month, and I will give you 6%. And then you get to take the state tax credits. And I cannot buy now. This only says view only. But I would turn around and say, I'll take that. Thank you.
What hours is the bond market open?
Same as the stock market. So when the market is open, the market is open.
I think it opens a half hour before the stock market, right?
Here is one thing I've learned through doing this for 3.5 years. Trying to go very early or going 1 minute before the market closes, you get all of these Mickey Mouses. So I just go in the peak of the day when the volume of traders is just insanely high. As you can see, there's also another thing going on. This person, 1,000 really means 1,000,000. So this person says, hey, you want to get this huge discount, you want to make this huge yield, you're going to throw $1 million on the table. This person says throw $100,000 on the table, but during the normal market opens, this would be $1,000. It would say one.
Right, correct.
And so the answer to that long question of where do I find the distressed bonds is, instead of just teeing off what Schwab shows in the main market, click on one of them, modify the search, and say, I will buy any duration whatsoever, and sort yield to maturity descending, and out comes the answer.
Perfect. Thank you. So let's take on this question. It's going to be a two-parter, so stay with me for a little bit. Regarding long-term treasury bonds, I think the thinking is with 10-year bonds, we have the option to keep it to maturity. However, if interest rates were to fall within 3 to 5 years, then does it make sense to buy these long-term treasury bond if interest rates were to fall? How does capital gain make sense?
Yep. First things first, I'll dispel this notion. Buying a bond whose duration is more than 1 year does not give you capital gains. That's a misnomer. So the government is too smart. They will tax you as ordinary income, any and all bond income, regardless of the duration. So it's a complete misnomer that buying a bond. I'm sorry, go ahead.
Yeah, and I'll just, so I personally know that, so if you buy a bond, just to keep it simple, you buy a bond for $500, they return $1,000 back to you. Okay. In the meantime, they paid you interest at 5%. Most definitely, the 5% is ordinary income. But the difference between $500 and $1,000 is capital gains if you keep it longer than a year. If you, let's say it was a 5-year bond and you bought it at $500 and it matures at $1,000.
I'm sorry, I'm going to correct you for a second. The only time you get capital gains in a bond is if you sell it above market value. So take an example of a bond that you bought on 96 cents on the dollar, and it matures, the par value is 100 cents on the dollar, and it matures in 5 years. If you held that bond from 96 cents all the way through 5 years, every single day the government will ask you to accrete a little bit of the difference between 96 and 100, and you will be paying that as your taxes along the way as ordinary income.
Okay.
If you sell that bond in the middle, and that's what this gentleman is asking, or this lady is asking, let's say interest rates were to fall dramatically 3 years later, and all of a sudden the 96 cents by now has a book value of 98 cents. I'm making that up because you would have accreted that all the way to 98 cents. And all of a sudden, the market only pays 2%. You, the genius, bought the 4.5% bond. Then the market will be willing to pay you 99 cents instead of 98 cents 3 years later. If you were to sell that bond 3 years later, that 1 cent is the capital gain for you.
Okay.
So here is the question that I would have for that person. Again, we are all making educated guesses about the future. If you were to buy the bond today at 4.5% or 4.8% on a 10-year duration, and you are willing to hold it for maturity, that is something that you need to always start with. If you are speculating and thinking that, oh yeah, I'm just holding it for the short term. Anytime you get into fixed income and you pretend that it's really not fixed, that doesn't make sense at all. If you are willing to hold it for 10 years, you are not going to lose money whatsoever. Even if your yield is not as good, you know what yield you're signing up for, you are good. If you say, well, I will hold it to maturity, but if indeed the bond prices appreciate above fair market value, and you can see that as well on Schwab, and it'll take me much longer to show you where you can see the difference between your price and the fair market value. If you're able to see that, and if you're willing to do that, sure, you can do that. But my warning again and again would be anybody who thinks, I don't really want long-term, I just want a little, side thing. There is no free money. Buy fixed income if you're willing to hold it to maturity.
Got it. Okay. So, I'm really getting a lot out of this session. And this is why, I'm a believer that I learned something from every investor. And, so I'm going to say that I grew up in the 1980s. That's when I was in high school and in college. And back then, they taught us a 40-60 rule. Have you ever heard of that, Badri?
Yep.
40-60 rule, 40% bonds, 60% equities. These were kind of like, age old principles that were suggested. And then I went through I have an accounting degree, and we would actually uh, determine bond values in our classes, because you would have to book them on a balance sheet and so forth. And then I went to MBA school, and again, there was always kind of these kind of rules of thumb. Fast forward, so I'm thinking in my fixed income along the lines that I was, educated. Now, is the education worthless that I got? No, it was very good because it taught me great mathematics. But in just listening to Badri's approach, he's kind of breaking some of these like age old wise tales that I heard, and kind of like I'm beginning to think more like he is. Like, wait a second, that makes a lot of sense. So I really appreciate you coming on, and I hope everybody's kind of getting a similar like, hey, you know what? I'm going to question some of these things that I had been following, in my case, for 30 years, and just kind of rethink it and say, maybe I should be completely all in on short-term bonds and not dabble too much with long-term bonds, because, again, I was told 30 years ago that was something that I should do. All right, so let me get to a question here. Shadow Guy, and Shadow Guy, by the way, is in Switzerland. And thanks so much, Shadow Guy, for the $10 donation. That's awesome. Thank you so much. And FYI, Shadow Guy, I found a chocolatier near me that brings in chocolate from Switzerland, and it's delicious, but it's a little expensive. And I took my wife. So I wanted you to know that. Okay, one warning about corporate bonds. It's definitely not zero risk, even for investment grade. Here in Switzerland, there was a scandal when Credit Suisse AT1 bondholders got wiped out in the USB buyout. Very good point. Any comments there, Badri?
Well, who gives the grade is the real question. For somebody to read, this is no different than the
I
wealth
can answer
management
that.
advisor.
The same guys that graded all that debt that created the subprime mortgage meltdown.
Yeah,
Continue on, please.
Yeah, Enron was investment grade, and so ultimately it's a bunch of people who are using reasonably publicly available information to say, I think that's their grade, and so I don't mean to discredit any or all of those people. I would put the zero risk in the same scale as the no management fee. No such thing. Absolutely no such thing.
And I'll bounce off of that a little bit. So I totally get it. Do I use analysts, grades to decide on a company bond? The answer is no. Now, I try to use a lot of the knowledge that I get from analyzing companies for stocks. For example, Kroger. Kroger is a bond that I've bought recently. Well, I'm a stockholder of Kroger. I've followed Kroger for 5+ years. I understand their business. Do I think Kroger is going to be around in 20 years? Yes. Do I think there's a chance that an asteroid is going to hit them and they go out of business? Yes, there is a chance. But I know that it's a very low chance, and I'm willing to buy a bond that Kroger issues. Now, that's the train of thought that I have. And of course, the U.S. government. Do I think the U.S. government's going to be around? Yes, I do. And that's my rationale. That's how I make decisions on bonds. I don't go to an analyst who says, oh yeah, like for example, J&J, I'm not going to say too many bad things about the company, but their credit rating on bonds is like the top of the stack. Can't be any better. At the same time, I'm like, wait a second, this is the same company that's dealt with lawsuit after lawsuit. Some of these lawsuits are massive. It could completely change their balance sheet, potentially make them go bankrupt. And they get the best credit rating? That didn't make any sense to me. So, all right. So we've kind of gone deep on fixed income. Thank you, Shadow Guy. And I did love the chocolate, but I had to go for a long walk afterward just to burn at least a portion of the calories. All right, good stuff. So I think, we've had a good session. Would love to have you back. Maybe we can begin to kind of land the plane a little bit. And if you can have some departing thoughts and kind of suggestions for an investor that's maybe 25 to 40 years old, then an investor that's maybe 40 to 55 years old, and the last being, an investor that's above 55 years old. So starting with that young investor, what would you want them to kind of think about? Maybe, study this up, maybe look into this area for your, which you think is going to help them be a good long-term investor.
All right. There is another question. I'm going to answer that as a way of answering your question. Live Free Investing says, why do you think there will be a stock market drop from now until November? Usually June and July, and I don't see a pullback. I am no expert in telling you when there will be a pullback and whether there will be a pullback and what percent. If I knew all of that, I would be the wealthiest options trader, and I'm not. I only do longs. I don't do shorts. And my instinct has nothing to do with the drop between now and November. I don't know where you are. Maybe you're in the US, maybe you're not in the US. Our ability to have a meaningful conversation about simple things. Did something happen? Did something not happen? Do you disagree? When we cannot have civil discourse as a society, and there is a really big event which determines power for the next 4 years, I just think there will be some turbulence. It doesn't mean that the market exactly is going to go down between November and then after November it's going to go up. I don't know what I don't know. But I go back to 5.5% state tax free on the amount I have in fixed income is enough for me to manage my cost of living and then some. And so why?
Let me remind you of the question. So you have a person that's between 25 and 40. They're not going to need this money for 30, 40 years.
I'm coming there. Yep.
You're kind of giving them a, hey, nudge in this direction, here are a couple pearls of wisdom.
So I'll come back to, in other words, I was answering the question that between now and November, I don't know what I don't know, but if I can live off my fixed income, I'm not going to take more risk. I'm going to ask you a question of 25 to 40, again, in a simple story. This 25 to 40-year-old person is going on a beautiful walk along with their significant other, and they are smart enough to carry a backpack with them. And what would they want in the backpack? Maybe they are picnicking. Maybe they want a blanket. Maybe they want some sandwiches. The question is, should they take an umbrella? And the way to answer that question is, what is the weather forecast for the next 3 hours? And then you can say the weather forecasters aren't always accurate. Let me look over the horizon and see if there are storm clouds or if there is a storm approaching. And my answer to the 25 to 40-year-old is, on a normal day, when between now and the next 3 hours is bright and sunny and it's spring, skip the umbrella, my friend. Pack the sandwiches, the blanket, go have fun. It's going to be a good time. No matter what your age is, I see storm clouds in the horizon, and that is my viewpoint. You should do your own due diligence. Having said that, I am choosing to pitch a tent because I think it is going to pour. But then once the rain stops, I am going to be out dancing in the rain. What I mean by that is I am choosing to take as little risk as possible, regardless of age, between now and after the election. But by golly, I'll be coming out to play in the equity market after. You do you. Just because you're 25 to 40 doesn't mean that you go out without an umbrella, because there are storm clouds in the horizon.
Very good. So I get that point of view. I would put it out there that, so I've, and I'm showing my charts here, but so the most recent crash was the one with COVID, right? And then obviously we had a very good equity correction in 2022. And I think freelance, live free investing, I really appreciate your question. Why do I think there's going to be a pullback of 10%? And I would answer by saying, history doesn't repeat itself, but it really rhymes. In 2023, we had a very good year. I don't think anybody's going to argue that. And in the middle of the year, we had a pullback that started in July and ended in October of 10%. So just less than 1 year ago, we had a pullback in the middle of the year. So is it going to happen again this year? I would say yes. It's probably going to happen. Would I be surprised if it didn't happen? Yes. Am I going to be shocked? No. Am I going to be happy? I'm going to be very happy because my equities went up. But I've been selling some of my positions, creating cash because I think that the market's expensive. I've said that a couple of times. Now, the other thing that I would say on crashes is I never sold one stock, one share during these crashes because it's so difficult to pick at what point do you sell, at what point you buy back. What I did do is I poured money into those markets. So if I look at the market that we saw in 2020, I poured money in. If we look at 2022, poured money in. 2008 to 2011, I poured a lot of capital into stocks and real estate, and it really paid off. So when things crash, I'm not asking for the stock market to crash. I'm just saying that when it does, it's great news because you pour in your capital and you're almost guaranteed a return. If you look at, hey, if you bought it near the trough of COVID, within 6 months, you increased your portfolio by 50% on the positions you bought. I mean, that's like guaranteed money. Or if you bought at the trough or near the trough of 22 to now, we're up 48%. So what I would say in answering your question respectfully, I appreciate your comment. Challenge anything you hear, but I'm willing to hear your message. I hope you're willing to hear mine and Badri's, because what I want is everybody that's on this, live stream, we just get a little better and we make more money and we learn something. And I would say that, I would expect the pullback this year. I wouldn't be shocked if it didn't happen, but you just look at history, look at data, and the data will tell you something. At least it tells me stuff. So we covered the young investor. Now let's just skip to like the older investor, like myself, 55. I'm looking at, hey, potentially retiring soon. And what advice and pearls of wisdom do you want to leave that investor with?
I would go back to that curve, the yield curve trends that showed long-term interest rates increasing. And once again, my message there for the older population as well, and somebody made a comment that is going to be money printing. Maybe there will be money printing. Well, if you own bonds, you are the one financing the money printing. And we used an analogy earlier of if I showed up with 5 pounds of tomatoes versus 20 pounds of tomatoes, I'm going to sell it for a lower price, and therefore you'll get a bigger amount. So even for the older investor, duration is the name of the game in fixed income. Asset allocation is the name of the game in investing overall. Even for the old investor, I would say if 5.5% is going to work for you, stay short term. If 4.5% is enough to pay for your living expenses and a vacation a year, by all means go long term, but hold it to maturity. Anything else, no matter what your age, the most sensible thing to do, if there is going to be money printing, wonderful. I will finance the money printing and make 6.5%. Why wouldn't I?
Excellent. And then I'm gonna ask for one more comment. So we've seen these inflation, and I forget the exact term, but inflation protected bonds.
Tips.
And
Yep.
tips, right? And I love them. Like 2 or 3 years ago when they were paying 11%. Tell us about those before we end.
So tips is a security that says, I'm going to give you 2% instead of 5.5% along the way. And when the bond matures, you pay me $1,000 now, and let's compare two individual securities, fixed income securities. And let's say that the regular one pays 5% just to make it easy. So you pay $1,000 here, I give you 50, 50, meaning 5%. Well, 5%, I'd give you 25, 25. So every 6 months, I give you 25 cents. So I'm giving you 50 a year, which is the 5% yield. And at the end of the 5 years, I give you your 1,000 back. That is the normal fixed income security you think about. The tip says, you give me 1,000 today, I'm not going to give you 25, 25. I'm going to give you, 5, 5. So I'm going to give you a really small coupon along the way. The reason is because when the bond matures, I'm going to give you whatever the buying power of $1,000 is on the date the bond matures. And you sit here and say, lovely, there is going to be inflation anyway. If I wait 5 years, instead of giving me back 1,000, you're going to give me 1,200. I am so smart. I'm going to go all in on tips. And I'm going to tell you, let me give you a couple of quick warnings. And I've done a 12-minute deep dive on these as well. To be clear, I do not own tips. And so you use your own judgment. The challenge is, first of all, you're giving up the coupon along the way. So instead of 50, you're making 20 or whatever smaller amount. And do you know what inflation is going to be 2 years later or 5 years later? You don't. I don't. You may get 980 instead of 1,000. All those whose tips matured in the middle of COVID got smacked. They got $800 instead of 1,000 because the government said we have deflation now. Hotel rooms are only $70 and whatever else it may be, CPI is negative. Instead of giving you 1,000 back, I'm going to give you 830 back. And you go, wait a minute, I thought this was fixed income. Well, if you gamble on inflation, sometimes you win, sometimes you lose. There is another thing as well. The market for tips is less than a quarter for the market for treasuries. So when you go to sell, let's say that halfway through you want to dump it, there aren't that many buyers for tips. It's a much more limited market, which means your spread is much higher. There are many other reasons, but ultimately you're gambling on what you think inflation is going to be and giving up the yield in between. That's what a tips is.
Yeah, and the reason that I was attracted to them is I don't need the money. I don't need the income. But the way I calculated it was the return was, upwards of 10, 11, 12%. And I believe, I started buying tips in 2021. And
so you're talking about I bonds. You're talking about I bonds,
correct?
They are not tips. So an I bond is an inflation bond that an individual buys directly from a government for 3 months and 6 months. So that's very different. Tips, there is something called tips that you can buy on any brokerage.
I wanted to talk about I bonds, and I apologize if I got us rolling in the wrong direction. But I bonds is something that, when inflation just went through the roof, I bonds is, in my interpretation, and please come in after me because you know this stuff better than I do, is the government says, hey, I'm going to pay you a little bit more than what the inflation rate is. Now, when inflation was tracking at 9%, these things were paying a very high return, and they pay you, I believe, in the form of income. So I bought the max for myself, the max for my wife 2 years in a row, and then I haven't done anything with that since.
So the I bond coupon is variable. And so there you don't have a fixed coupon. The coupon is based on the rate of change of CPI. So you buy an I bond when inflation is on an increasing trajectory. You run from them when inflation is on a decreasing trajectory, because again, so there is a time and place for everything. And if you bought it in 2021, you look like a genius because every quarter it was 7%, it's 9%, and now the messaging is it's 3%, it's falling again. So you make the opposite of what you would make before.
Well, I'm really attracted to yield, and I started seeing that, and I started buying them because I'm like, hey, every angle that I look at is this is a good deal because I was, again, principally a real estate investor, stock investor. Here's a way that I can get more bonds, because at that time I had very little bonds. Bonds were like untouchable, near zero. It's like, no, thank you. I'd rather keep my own money in my bank account if you're going to pay me nothing. So I'm glad we covered that. All right. So this has been a really good session. I think we went deep, and I'd love to have you come on again, maybe in a month or two, and kind of take the next step. In the meantime, everybody, visit Yield Nerd. The details are in the live stream, description. Please like his videos and subscribe to his channel. As you can see, he's got a lot of deep expertise around fixed income. And at some point, I think in any investor's journey, it becomes a really viable and important part of a portfolio. I mean, we're not going to own, growth funds forever, growth stocks forever. I will always have stocks. I can't see myself without them because they're just, to me, very interesting. But at the same time, I continue to expand my fixed income because, like, Badri said, hey, I want to eat every month of the year. I want to pay my electricity bill. I want to pay my bills. I need my internet. Can't live without internet. And that's where my bond portfolio, as well as my dividend paying stocks, are going to take care of me. So Badri, thanks again so much for attending. Really appreciate it.
Thank you. Have a good one.
All right. We'll see you guys.
Bye-bye.